Well, good afternoon, everyone, and welcome to the first in the Vincents Weekly Update series. So today I'm going to be talking about superannuation, and essentially there's a couple of elements that we'll be talking about today, not only updates that have happened recently, but more importantly, I suppose, a refresh on the rules that apply now, particularly just leading up before 30 June, because obviously we've had some very significant changes within superannuation that started this financial year. So it's worthwhile just doing a bit of a recap on those before 30 June, just to make sure that all the planning is in place that needs to be there. So who am I? My name is Brett Griffiths. I look after the self-managed superannuation area here at Vincents, so Director of Superannuation Advisory. So I look after the self-managed super funds, as well as looking after legislative compliance and advice in relation to that particular area. And my contact details are there as well. Important disclaimers. Now, obviously you can believe everything I say, but you can't actually use it for your own personal circumstances unless you talk to us. Standard stuff. So moving on, if by the end of this little webinar your brain doesn't look like this, then I have not succeeded in my mission to thoroughly confuse you and make you appreciate just how confusing superannuation is in our new world. So moving ahead, what are we going to be talking about? So firstly, a little bit of a recap on the transfer balance cap, and then the interplay with that in relation to the transfer balance account reporting. So that's a really big thing that's looming large for accountants and administrators coming up to 1 July. Then we'll have a bit of a chat about the non-concessional contribution caps, and then about the concessional contribution caps. We'll talk about the downsizer contribution provisions that commence from 1 July 2018, as well as just a bit of a recap around the catch-up contributions in relation to new rules that once again start from 1 July 2018. We'll have a discussion just very briefly about transition to retirement income streams and what that means under our new world. Talk about reserving. The ATO has been publishing some material in relation to that topic. And then some recent updates, if you like. There's a Treasury consultation paper in relation to non-arm's length income, and then there's been a recent case on the sole purpose test. So we'll have a bit of a quick chat about that as well. So moving on, transfer balance cap. So as a bit of a recap, the transfer balance cap is basically a method of tracking money in retirement phase. So remembering that retirement phase isn't a TRIS, so it's not a transition to retirement income stream. It is, however, an account-based pension, defined benefit pension, market-linked pension, flexi pension, a few other types, but it's not a TRIS. So typically in self-managed super fund world, we're only talking about account-based pensions, maybe market-linked. The idea around the transfer balance account is that it measures an individual's transfer balance. So in other words, how much they actually have inside retirement phase. So there's a series of sort of credits and debits that help come up with that magical figure. Now, remembering that all of this starts from 1 July 2017. So if you're already receiving an income stream in retirement phase, or if you start a new pension, say today, then that is when your transfer balance account starts. So no one actually has a transfer balance until it's actually reported. So until you tell the tax office that you've got a pension or you're about to start a pension. Now, this is a whole new world essentially, because since 2007, we haven't had to actually report when pensions start. Way back in the day, we had to. So between about 2003, I think it was, and 2007, we had to report when pensions commenced, but we haven't had to do that for the last decade. But now we're having to do that again. So essentially, there's a whole regime and how that works. So this transfer balance account is actually reported to the tax office, and there's a regime in which when that happens. So the idea around the transfer balance account is that it determines if someone has exceeded their cap, their transfer balance cap. So we've got the transfer balance account, which is how much you actually have inside super, and your transfer balance cap, which is how much you're not allowed to have any more than inside retirement phase, inside super. So the important thing in relation to that is that your transfer balance cap is at the end of any given day. So if you have two events that happen on the one day, then so long as they net each other out, you still have to report, but it doesn't impact on your transfer balance cap. So the transfer balance cap, it's a limit on how much can be with inside retirement phase for an individual. So you've probably heard about the $1.6 million cap. That's what that is. And it also takes into account all of your superannuation interests. So not just what's in one fund or in another fund, it's all super funds. So that's a really important thing to remember. So if you have a self-managed super fund that has $1 million in pension phase, and then you have a retail fund that also has $1 million, or a CSS pension, for argument's sake, that has a special value equal to $1 million, then you've breached your cap, and things had to have happened before then. So the transfer balance cap itself, essentially, it's a series of credits and debits. So a credit is when you start a pension. If you have a reversionary pension, so a spouse dies and they receive that pension from the deceased, or if you have a notional excess transfer balance amount. So that's when a credit exists. A debit, on the flip side, is basically when a pension stops. So either commutation, so that's where a part of the pension is taken from pension phase and put into accumulation phase, and or if you stop the pension completely. There's also some other rules in relation to matrimonial matters, if there's bankruptcy proceedings, and also if the commissioner gives you a notice to say, hey, you can treat that as a credit. So there's particular circumstances where you can write to the tax office and ask them for their discretion, if you like. So essentially, the sum of those things gives you your transfer balance account, is your transfer balance account. Now, that is what is reported to the tax office on this thing called a transfer balance account report. Now, the frequency of that reporting actually depends on the member balances. Now, it's their members' total superannuation balance. And it doesn't actually have to be the member that's in retirement phase. It's for self-managed super funds, this only applies to. It is actually any member inside that fund. So for argument's sake, if you had two members inside the fund, you had one member that had a balance of $2 million, but it's in accumulation phase, so not in pension. You had another member that has $500,000 that they move into pension phase, then that fund's obligation to report that event, that commencing of the pension, is different than if that was a sole member fund that only had $500,000 moving into pension phase. So what do I mean by all that? Transfer balance account reporting. So it's a bit of a process in relation to all of this. So the first thing that needs to happen for your TBAR, transfer balance account reporting, also known as event-based reporting, because you're only reporting events that occur. However, what it means is that the first event is if the super fund, already has a pension as at 30 June 2016, that is continuing. Then that actually needs to so that's 30 June 2017, and continuing. Then that actually needs to be reported to the tax office on or before 1 July 2018. Now, as far as I am aware, only Supermate has the ability to actually automatically, I'll say automatically, but has the ability to report the transfer balance of cap reports to the tax office. We use Class Super, but I believe BGL is essentially in the same boat, so they're the three major providers. But Class Super is saying that they will have their facility to determine these amounts next month. So here at Vincents, we'll be looking to undertake this reporting in June. So that way we're before the 1 July deadline. Now, that's for existing pensions. So 30 June 2017 income streams, account-based pensions. TRISs, remember, don't count. We don't really worry about them in this case. But then the trap, if you like, or the trick is in relation to total superannuation balance. So for a self-managed super fund, there's actually different reporting requirements dependent on the balances of the members of the fund. So I used the analogy before where you had one member who is $2 million in accumulation, one member who is in 500,000 moving into pension. So the question is, when does that T-bar have to be reported to the tax office? Well, ultimately, it comes back to this notion of total superannuation balance. So in other words, we need to know what the member's superannuation balance was as at 30 June of the prior year. So in other words, if we have an event that happens now, so that $500,000 pension starts today, we have to go back to the total superannuation balance as at 30 June 2017 for the members of the SMSF. Now, that is regardless of where that superannuation monies are. So if they have $1 million in Q Super, we need to know about that. If they have a CSS pension, that has to come into it as well. Now, that's great in theory. However, where you are not the individual tax agent for a member of a super fund, we can't actually obtain their other superannuation balances. Where we are the tax agent, we can. So we've already gone to the tax office and obtained a file that has about 2,000 lines in it of our entire client database and their superannuation positions. But we have a lot of clients where we're not the individual tax agent, so we don't know that information. Now, the members themselves can obtain it via a system called MyGov. So that's an online portal that the government has created that you can allow to view things like Medicare records or superannuation records, tax records, that sort of thing. So you can obtain that information from that. In discussions I've had with the tax office on this recently, tax agents will have the ability to view members' superannuation balances in about August or September this year. So essentially, if we are the administrator of a self-managed super fund, we already have the members' details. We will be linked to that individual to view only their total superannuation balance information. But that won't be until August or September. That's a bit of a problem. But regardless, that's the system we're working with. So why does all this really matter? It matters because if you're over $1 million, the event, the pension being reported, the pension stopping, whatever is going on, has to be reported within 28 days after the end of the quarter. So for argument's sake, if an event happens today, and we're sitting here in April, so that means that has to be reported by 28 July 2018. If an event happens, if the total superannuation balance of all the members is under $1 million, then we don't actually have to report that until we prepare the tax return for the super fund. So typically that's 15 May, so it will be due then. Now, in talking with a lot of administrators, they're just going to be assuming everyone's on quarterly and reporting on that basis. And look, the reality is we will probably do the same. So all of our trustees will be receiving a letter in the not too distant future advising of our process and asking essentially for help in regulating or administrating, I should say, this new system, because we're going to have more up-to-date data so we can be more on top of this reporting requirement. So we'll be touching clients' information a lot more frequently, which means that they'll have opportunity to have more information on balances and things like that. So we're going to be starting a process of more regular processing. And as I said, this will be all communicated in a letter that's coming out in the next couple of weeks, hopefully. So look out for that little bit of joy. Now, one thing I will also mention is that once the reporting time frame is set for a self-managed super fund, it doesn't move. So let's say, for argument's sake, we have someone who is over $1 million and then their balance drops to $500,000 and they do another reporting event. They still have to report on the assumption that they're over the $1 million, so the 28-day time period. Now, this is going to be an absolute nightmare for when you move between accountants, because at this stage, we don't know what the reporting timeframes historically will be. Admittedly, we're not in that regime, but presumably the tax office is going to have to come up with a way that they can tell us under which basis the client is reporting their T-bar. That is going to be, if they don't, then no one's going to have any idea. And once again, it will essentially reinforce the notion that a default position of 28 days after the end of the quarter will just be what everyone ends up doing anyway. So that'll be very interesting how that actually plays out in real terms. And the practicalities around all this is a real challenge. So not only are we trying to process the practicalities of all the super changes, but we're now trying to implement new systems and processes around what these changes actually mean. So a little bit of an example to sort of flesh that out, if I may. So we have Alison. She's a sole member of a self-managed super fund, and all of her total superannuation balance is inside that self-managed fund. So very straightforward and very simple. Now, if she starts a pension, so she starts a pension on 31 July 2017. So it doesn't have to be reported on or before 1 July 2018. It has to be reported by 28 July, the 28th of October. So that's 28 days after the end of the quarter. So in other words, the September quarter, 28 days after that. Now, on the 1st of January 2019, she commutes $500,000 to a lump sum. So she takes $500,000 from the pension account and takes it into the lump sum. Then on the 30th of June 2021, she contributes $200,000 and she puts that into a pension phase. So as you can see there, the T-bar reporting around all this is that we have a pension commencing for $1.2 million, so that credit gets reported. Then we have a $500,000 debit being reported on the 1st of January 2019, and then on the 30th of June 2021 we have another event being reported, being the starting of another pension. So for everyone to put on their little thinking caps here for a minute, I've got a quick little poll question for everyone. So hopefully that will pop up now if I do that. So in front of you, you should have a little question. So when do you think the T-bar needs to be reported for the second pension commencement? So that $200,000 pension, when do you think it needs to be reported? So the first response, the first question answer, 1 when the annual report is lodged, because the total superannuation balance of the fund is now less than $1 million, 28 days after the end of the quarter in which the event occurs, or it doesn't actually need to be reported because that $900,000 total superannuation account is less than what was originally reported at 1.2 million. So if you can just have take 30 seconds to put in what you think is the right answer, either A, B, or C, and then we can flick up the results. So don't be shy, everyone. Have a guess. Excuse me while I have a drink of water. So, all right, I can see we've got some responses there. That's excellent. Another 10 seconds. And all right, I'll end the poll now there. So let me do that. Oh. So the correct answer is actually B. So B is always the right answer as far as I'm concerned with multi-choice. So regardless, because the first reporting of this self-managed super fund, the total superannuation balance for Alison was $1.2 million. That 28 days after the end of the quarter time period is locked in. So that means that for every future event, including the commutation back to 500,000 and the commencing of the second pension, all has to be reported 28 days after the end of the quarter. So that continues regardless of how long this fund exists. So if we have a commutation in 20 years' time under the current regime, then that has to be reported 28 days after the end of the quarter. So as you can perhaps appreciate, that this is going to be a lot of good fun for accountants and administrators going forward. So particularly, if you think about this for a minute, let's say an event happens now in this quarter. So basically, the entire super fund has to be prepared and ready for lodgement by the 28th of July, if that event occurs, because in the example that we've got there, so on 30 June 2021, that commutation has to be reported by 28th July. So on the 28th of July, you have to actually know what the entire balance of that fund is, essentially. Unless your accountant or administrator is doing regular reporting and essentially up-to-date information on that super fund, they won't be able to do that. They might be able to take a stab in the dark, but it won't be accurate. So this is going to be a real challenge for everyone, particularly if you have unlisted investments or property potentially, because you'll need a valuation. There's going to be a lot more planning required around things happening around pensions, around these events that need to be reported. So while we haven't yet entered this wonderful new regime, it's something that accountants and administrators really need to be thinking about. Certainly we've turned our mind to it. We've had a lot of discussions and planning meetings basically about how we're actually going to run this new process. So it's going to be an interesting new world, let me put it that way. So moving on, non-concessional contributions. So when a member's total superannuation balance, a member's total superannuation balance now dictates when a member can actually make non-concessional contributions. So once again, a really good reason why you would want up-to-date financial information on a self-managed super fund. So if a member's total superannuation, and remembering it applies to the 30 June prior to the contribution being made. So if you've got a client who wants to make a contribution in July, you've got to know their 30 June balance. If they want to make a contribution today, then you still have to know the 30 June balance. So it doesn't matter sort of what happens in between. So basically, this notion of $1.6 million applies. Now, this is not the transfer balance cap. It's a different cap. It's a different limit. This one doesn't get indexed. The other one does. So basically, if you have less than $1.4 million inside super, then the member can make, whoops, I've said 3,100 contribution there. That's actually 300,000 NCC. So I'll fix that up before we send this out. The total, if the member's balance is between 1.4 and 1.6, or essentially between 1.4 and 1.5, then it's a $200,000. If it's between 1.5 and 1.6, then it's only $100,000. Now, even if that balance is 1.597, they could still make a $100,000 non-concessional contribution. As soon as that goes above, that member balance goes above 1.6 million, they're excluded from making non-concessional contributions. They can still make concessional contributions, but not non-concessional. So knowing the member's total superannuation balance, once again, will be really important for strategy and advice around making contributions into super. So it more once emphasises the ability to have up-to-date information will be needed. Transitional non-concessional caps, I won't really talk about this too much, but needless to say that if a non-concessional contribution has been made in either the 16, 17 or 18 financial year, it will essentially impact how much can be made in the subsequent years. So that little table there is designed that you can print that out, put it somewhere and refer to it if you've made contributions previously. So I won't really spend any more time than that on. Concessional contributions, essentially just a reminder that we now only have a $25,000 contribution cap for everyone, regardless of age. Previously, we had an age requirement. One thing that has also changed from 1 July 2017, so the current financial year, is that source can come from anywhere. It doesn't have to be an employer, a salary sacrifice arrangement from an employer. If your employer pays in $15,000 as SGC into super, you can personally put another $10,000 into super and claim a tax deduction for it under this mechanism. So basically, the source of funds is now irrelevant, which is a great thing. However, the work test still will apply for those that are over 65. Also, bearing in mind too, those that are over age 75, the super fund can only receive SGC contributions. So you can't add additional money into super, only SGC. Downsizer contributions. So this is it was introduced in the last budget around essentially home affordability. That's how it's targeted. So the basis behind this is allowing older Australians, those over age 65, to make additional contributions into super when they sell their main residence, they sell their home. Now, no caps apply to this. The previous caps don't apply to this. So we're just talking about the non-concessional caps of $1.6 million. That doesn't apply to this. So you can have $8 million inside super and still make a downsizer contribution into super when you sell your home. So there's a few conditions around it which are listed there, spoken about over 65. So the source, basically, it has to come from the capital, all or part of the capital proceeds from selling your home. The contributor or their spouse must have owned an interest in the house that's been sold. The house had to have been subject to the main residency exemption for capital gains tax purposes. So there's a few little tricks around that if you've moved out of this house for up to 6 years. So things to think about around that. The timing of the contribution, it has to be made within 90 days of the change of ownership, so 90 days from the sale. And the length of ownership, you've had to actually own that home for more than 10 years to use these provisions. Now, the contract date, so when the contract is actually entered into, is important around this as well. It's not about settlement, it's about when the contract is entered into. So it has to be after 1 July 2018. Now, interestingly, you don't actually have to buy another home. You don't even have to downsize. You just have to sell your home. So you could actually sell your home, in the suburbs, move into the city in a penthouse unit and spend $4 million on that unit. You sold your home for $1 million. That's okay. You're still able to use these provisions. So the downsizer is a bit of a misnomer. You don't actually even have to buy something else. You could, for argument's sake, you could rent. You can still use these provisions. The source of funds doesn't actually have to be a nexus between the sale of the house and the contribution being made. So in other words, you could receive the money from the sale of the house and use those monies to pay down debt. And from other funds that you have, you can make the contribution into super. So there doesn't have to be a direct nexus between the two. And as I mentioned, the $1.6 million non-concessional cap doesn't apply to this. Same with the normal work test requirements. They don't apply to this either. You can be as old as anything and it makes no difference, so long as you're older than 65. Unused concessional contribution caps. Now, this is a provision that starts from 1 July 18. However, you don't really get the full bang from it for another 5 years. So the premise behind it is if you have less than $500,000 inside super, you can go back 5 years, have a look at the concessional contributions you've made into super, and basically claw that back and claim a tax deduction. So if you've only made $10,000 contributions for the past 5 years, you can actually go back and claim an extra $15,000 for those years and put it into super. Now, this is really targeted for probably the non-working spouse to increase their superannuation balance. Now, as I said, really you're looking at a time frame of 2023 before you can take the full effect of this. However, Labor have said they will get rid of this policy if they become elected. So I wouldn't be hanging my hat on this as far as a strategy goes. So just bear that in mind. Just quickly, transition to retirement income streams. From 1 July 2017, they're no longer a retirement phase income stream. So no longer a pension per se for tax purposes. So under SIS, they still are. So you can still receive your 4% to 10%. However, you don't get the tax deduction that would otherwise be afforded to them previously, to the assets supporting that pension. So subject to normal taxation arrangements, as if the money is in accumulation phase. And also you can no longer say, well, I'm taking a lump sum out and treating it as part of my pension. So just a couple of things to think about there. So then that sparks the question, well, what do you actually need to do to change a TRIS into an account-based pension? Condition of release is what it comes back to. So the first one is attaining age 65. So turning 65 is an automatic condition of release. Permanent incapacity is one, terminal medical condition is another, and retirement. Now, retirement's a really interesting one because depending on how old you are when you retire, there's different criteria that you need to meet. So under age 60, you have to retire with a view to permanency. Between age 60 and 65, that retirement arrangement only needs to be the cessation of a gainful employment arrangement. So in other words, a job that you've left a job that was paying you something. So you could have had two jobs, you might have had a directorship on another board, something like that. you only have to stop or cease one of those jobs. You can then go back to work if you want or whatever. So think about the Australian Electoral Commission, where these, they need lots of people for very short, limited time periods. You could undertake that work and satisfy this condition. So just something to think about. Reserving. Now, the ATO has actually released a brand new thing, and this brand new thing is called an SMSF Regulators Bulletin. So the first cab off the rank of the SMSF Regulators Bulletin is in relation to reserving. So basically, the ATO is concerned that SMSFs are using reserves to essentially circumnavigate restrictions around contributions, so the non-concessional contributions, and the transfer balance cap. Now, to me, the risk for the taxpayer or for the broader tax community is minuscule. If you have a reserve, then yeah, great, you can get more money into super. But then when you allocate that money from the reserve to an individual, it's potentially subject to tax anyway, because you can only transfer out your concessional contribution cap amount. So if you have a large amount in reserve, it's going to take you a long time, and potentially there's going to be a tax impost on the member receiving it anyway. Furthermore, when it's sitting in a reserve, it's still subject to tax. So if the rest of the fund is in pension phase and you have a reserve, that reserve is like an accumulation balance. So I think this is basically the tax office chasing down in a rabbit hole that doesn't really exist. Or if it does, I think they've got better things to be chasing than really what this is going to give them. But regardless, they consider it as a hot topic. And they've also indicated as part of this that any funds that set up reserves or the reserve balance increases or even potentially decreases, they're going to audit those funds and have a look as to what's going on. So yeah, they're taking it reasonably seriously. Look, I don't really know how prevalent reserves are with inside self-managed super funds. We look after about 550 funds. That puts us in the top 2% in the country, apparently, as far as one administrator. We have one fund that has genuine reserving, investment reserving. So, as I say, I don't really think this is a hot ticket item. Non-arm's length income. So, Treasury put out a consultation paper earlier this year in relation to NARLI, as it's called, the acronym stands for. Now, basically, non-arm's length income is where a self-managed super fund receives income that it would otherwise not receive if the parties were dealing with each other at an arm's length basis. And this income is taxed at top marginal tax rate. So regardless if it's in pension phase or not, top marginal tax rate. So basically, if you think of a situation where you have a family trust that makes a distribution to a self-managed super fund, that distribution would be considered non-arm's length income and taxed at top marginal tax rates, regardless of if the fund is in pension phase or not. However, this consultation paper expands that definition a little bit more, sort of extends the reach. So basically, it's going to include where a self-managed super fund incurs a loss, outgoing, or expense that is less than might have otherwise been expected if the parties were dealing with each other on an arm's length basis, and also where there is no loss, outgoing, or expense incurred because by the SMSF where one would have expected it. So this is more about where self-managed super funds lend money, where a related party lends money to a self-managed super fund, that perhaps they can manipulate the results and give a different tax result based on expenses inside the fund. So once again, it's still only consultation, but something to think about if you have related party arrangements, there's another level of complexity and investigative requirements that need to go into it to make sure that NALI doesn't apply. Now, non-arm's length income, it actually is a self-assessing provision. So the trustee, via their tax agent presumably, makes the determination if it's NALI or not. However, if the tax office come a knocking, then they can say, no, you were wrong, and they can then issue interest penalties and the like because you've basically made a false declaration. So it's an area that just needs to be considered as part of the preparation of the annual accounts at the end of the year. And finally, the sole purpose test. There was a case back in February between a self-managed super fund, the trustee of that was Aussie Golfer Proprietary Limited, and the tax office, where basically the super fund had invested in a managed investment scheme run by Domacom, I should say. Now, Domacom is actually a publicly listed company, and it runs fractional investing inside property. So it basically does that by having these managed investment schemes underneath it. So you invest in Domacom, and then from there you receive units in a sub-trust, being the managed investment scheme. These managed investment schemes then go off and buy property. And Domacom have been sort of saying, well, the super fund is not directly investing inside a trust that is then a related party is using, so that's okay. So anyway, one of the directors of Domacom basically put this to the test and did this inside their self-managed super fund, received the units in the sub-trust, and then their daughter stayed in the unit that this sub-trust invested in. The commissioner came along and said, no, we've got an issue with it. We think it's an in-house asset. Even if it's not an in-house asset, under the regulation, under the SIS Act, we're going to deem it an in-house asset anyway because we just don't think it's right. We don't like it. And then they went down the avenue of what's called sole purpose. So sole purpose is basically the overarching principle behind superannuation. The sole purpose of any superannuation investment or transaction has to be for the sole purpose of the retirement savings. So what they were saying is that, well, from the outset, the trustee said the sole purpose for them investing in Domacom was to give their daughter a place to live. So that breaches the provisions of retirement savings. So therefore, the tax office said, we are breaching you for sole purpose test. Only the tax office can actually do that. The trustees went to court, probably funded by Domacom, to challenge it, and the full court actually said, we agree with the commissioner that it's breached the in-house asset and sole purpose. So there's been a few cases around sole purpose, probably not one since about 2014, I think. So it once again just emphasises the fact of the whole reason why superannuation exists. So finally, I just want to have a quick mention of a product that we've got here in relation to capital gains tax relief in relation to the 2017 tax returns. So some of you will appreciate that with the significant changes for superannuation, the Act allowed us to use to essentially refresh cost bases of assets in particular situations. So as part of our VinLink offering, if you like, we'd like to sort of help clients make sure that they're getting the right information, the right advice, and the right things are happening. So for all of our self-managed super fund clients, we do this already as part of our service. And those where we think it's appropriate, you'll receive correspondence with us before we do anything, so you know what's going on. However, for other sort of accountants that aren't too sure about it, we're happy to help you and look at the arrangements. So to basically make an assessment if you're eligible for, or if your fund is eligible for capital gains tax relief around this new regime. then $220 if you would like us to actually make a full assessment on it as far as values and how much you could actually claim and all that sort of thing, what it would mean tax-wise, then there's a little bit more for around that. So if you're interested in taking up on that offer, email address there is smsf@vincents.com.au, and we'd be more than happy to help because it's a really complex area. Every client situation is different. As I mentioned, we've got about 550 funds. We've probably got about 100 funds that we're applying this relief for. Every client situation is different. No two are the same. So if it's not something that you're comfortable with, it's good insurance to make sure that you've got it right, because I can see a lot of PI claims coming around not applying the relief in future years. So this is a one-off opportunity that relates to the 2017 year. So basically you've got until 30 June to make the election, otherwise you can't use it. So it's worthwhile giving it some consideration about if you can use it or not. And I don't think we've had sort of any questions along the way. And if we have, then what I'll actually do is I'll respond to those personally, and we'll deal with that. So I can see we've got a couple of questions there actually, but it more relates to around the webinar itself. So hopefully that's all been sorted. But if you have any questions, by all means, send me an email from my contact details on the front screen. Otherwise, I hope you've had some value in the webinar today, sort of what's coming up as far as planning opportunities and all the rest. So any questions, by all means, reach out. Otherwise, thanks very much for listening and watching, and we'll speak next time. Thank you.